Welcome, everyone, to today's webinar, The 3 Hidden Risks That Keep Investors from Truly Passive Income. Today's session is about protecting 3 things that most of us care about deeply: our wealth, our lifestyle, and our peace of mind. I'll walk you through the hidden risks that creep into so-called passive strategies, then show you a practical framework for building income that's predictable, hands-off, and grounded in real assets. My goal is not to sell you anything, is to provide you with information to make calmer, clearer decisions about where your money sleeps at night. So before we dive in, I do need to mention a quick but important disclaimer. This presentation is purely educational. It is not an offer to sell or a solicitation to buy securities. If we ever discuss an offering, it's strictly for accredited investors and only through official documents such as a private placement memorandum or what's known as a PPM. Investing involves risk, including loss of principal. Past performance is not a promise of future results, and before acting on anything that you hear today, please consult your financial, legal, or tax advisor to confirm suitability for your specific situation. Okay, so as some of you may know, I'm Abby Robinson. My background is in accounting. I'm a licensed CPA, and I started my career in audit and tax right out of grad school, serving high net worth tax clients. So I got really a front row seat to see how people built and preserved wealth over their lifetimes. And I thought I was following the same formula, just with fewer zeros in my bank account. But the truth was, public accounting turned into a feast or famine lifestyle. I was dealing with 80-hour work weeks, 7 days a week, followed by boring stretches of staring at my colleagues waiting for the next busy season. I was exhausted and restless at the same time. So that uncertainty pushed me to find a more balanced path, so I moved into the private sector. I worked as a controller for several business owners, and I thought that that would bring stability, but what I found was something different. I realized that my little 401k wasn't growing fast enough to buy back my time. So I started researching how to make my money work harder. And so one day I picked up a copy of the book, Rich Dad, Poor Dad, and it flipped a switch for me. It set me down a disciplined path into real estate investing. My wife and I started saving aggressively, and after a few years of doing that, we had enough money to hire a coach and then invest in our first real estate deal. So my partners and I were actually still working W-2 jobs when we invested in our first real estate deal, but we didn't let that stop us. In our first year, we actually took down 18 doors, which it was a whirlwind. It was exciting, sometimes terrifying, but definitely filled with lessons that we didn't even know that we needed. So it was a lot of fun in that first year. Then came year 2. What I now call my last straw moment. In this particular situation, we had purchased a mobile home park. It was our biggest asset purchase to date, financed with a short-term, high-interest hard money loan. So the plan was simple. We were going to remove the squatters, we were going to renovate it, and then we were going to stabilize it by bringing rents up to market. And then we were going to refinance within a few months. And we did everything right. Until the bank that we had lined up to refinance us out of the hard money loan suddenly backed out. It was around June 2022. Interest rates had just increased. The market started acting funny after a wild few years in the real estate space, and what had looked like a textbook success turned into a financial and emotional firestorm overnight. We could not find a lender to finance us out of our hard money loan. I probably called 3 dozen brokers, tried to get in touch with private money lenders. Nobody wanted to finance our deal. So that experience changed everything for me. And yes, we survived that situation. We still have that mobile home park because I learned how to collaborate and learned how to syndicate, which I can get into another time. But it taught me that wealth is not about chasing returns. It's about building structures that can weather change, right? It's about predictability. It's about stability, passive income. So That realization became the foundation for what we do today through our investment and lending company by helping investors create truly passive income backed by real assets. So, income that doesn't depend on luck or timing or tenants. You'll hear me return to those themes again and again throughout the presentation today. And just as importantly, it gave me new purpose to give back. I'm passionate about teaching and mentoring other investors, especially fix and flippers and high achieving professionals, so that they can then build income that they can actually count on. Because at the end of the day, the goal isn't just dollars, it's peace of mind from financial freedom. So that's a little bit about me. Let's talk about our roadmap for today. First, we'll unpack the 3 hidden risks that sabotage truly passive income. Second, we'll define what real passive income looks like beyond the buzzwords. Third, I'll give you a step-by-step framework that you can then apply to any opportunity. Then we'll open it up for live Q&A so that you can pressure test these ideas against your own goals. And then finally, we'll have a fun little freebie giveaway at the end of the presentation as well for you guys. Okay, so who does this help? Who's it for? Well, this session is for investors who want predictable monthly income without trading more hours for dollars. So if you'd rather have security than speculation, if you want more freedom than financial stress, you're in the right room. So think of this as a calm counterweight to market noise and the hustle of active management. All right, let's get into these risks. Risk number 1, this first risk is instability masquerading as income. So we all know that the markets bounce around. Some days are up, some days are down. If your paycheck depends on selling investments out of the market, that roller coaster can make your income feel pretty shaky. So, and the real pinch, for instance, is when you need your retirement dollars during a drop in the stock market, which means that you have to sell more shares to get the same dollars, which leaves you with less invested to recover later. This concept is known as sequence of returns risk, and it means that the timing of your gains and losses with the stock markets matter. This is a little bit nuanced, but super important. So if the market drops right as you're starting to take withdrawals during retirement, you're selling more shares at lower prices to get the same cash. Even if markets recover later, those early sales can leave you with fewer shares to bounce back, which then raises the risk of you running out of money, right? This is the most dangerous in the years just before and after you retire, when your nest egg is the largest and most sensitive to swings in the market. So let's picture this. We'll have 2 neighbors. We've got Alex and Jamie. Each have retired with $1 million, and each needs $4,000 a month to live off of. Both of them have the same average 10-year return. Let's just assume that. But Alex's first 2 years are down, while Jamie's first 2 years are up. So when Alex pulls money during those early down years, he has to sell more shares at lower prices just to get that same $4,000. Even if markets recover later, the bounce back only applies to the smaller pile of shares. So as you can imagine, 10 years in, Alex ends up with much less than Jamie. So same average return, very different outcome, all because of the order of returns. That's sequence of returns risk. In short, market volatility creates withdrawal pressure. Withdrawal pressure creates stress, not freedom. All right, so what does this mean for investors? Well, sequence of returns risk ties your retirement paycheck to Wall Street's mood. So when markets drop and you still need cash, that locks in the losses, which leaves fewer shares to rebound, and then if repeated, can shorten the life of the portfolio. Subsequently, this raises the risk of outliving your savings, even when long-term averages look just fine. So the remedy is structural, actually. Stop funding monthly needs by selling volatile assets. Instead, separate a growth bucket that can ride out swings from an income bucket designed to pay on a schedule. Okay, so let's talk about how to avoid this doom and gloom sequence of returns risk. Again, separate growth investments from your income investments. Let the growth bucket participate in long-term appreciation, but cap your stock market exposure based on your tolerance and time horizon. And then use your income bucket for predictable cash flow. So sources that are designed to pay on a schedule so that you're not forced to create gains at worst times. The mental and structural separation reduces the urge to make emotional decisions. So here's a simple framing that you can apply this week. Ask each line in your portfolio, is this primarily for growth or for income? If you can't answer, you may be asking one asset to do two jobs. So clarity around this helps you benchmark success appropriately. Growth assets are judged on a total return over time. Income assets are judged on reliability and risk-adjusted yield. Okay. Risk number 2, landlording. All right, the idea that rentals run themselves is a complete myth. So, in reality, tenants, vacancies, repairs, evictions, those can all turn mailbox money into a second job. And it often shows up at the least convenient times. So, for busy professionals or retirees, the operational burden can quietly tax your energy and your relationships. And again, for many, it becomes a job, not freedom. So, what does this actually mean in real life? Income often stops right when problems start. So if you have rentals, whether they're long-term, short-term, mid-term, during turnovers of your properties or during renovations, or maybe you're dealing with legal issues, cash flow pauses or reverses while expenses spike. So the more that these issues stack up, the more that your calendar fills, which means more time managing, less time living. And the hidden stress begins to erode your lifestyle, even if the spreadsheet on that property still looks good. So ask yourself this. If you had to step away for a few months for, say, travel, health, maybe family reasons, would the income continue without you? And if the honest answer is not really, then the strategy is active, not passive, regardless of how it was marketed. So here's how to escape the landlord trap. Step 1, pressure test every passive plan with this question. If I stepped away for 6 months, would this still produce income? If you own rentals, use professional managers with clear performance metrics and reserves for maintenance. Your time is far too valuable. And then if you prefer to eliminate tenant exposure entirely, explore structures where the customer is a borrower, like real estate secured lending, so that your role centers around underwriting and monitoring, not midnight maintenance. And I'll go into a little bit more detail about this later in the presentation. Okay, risk number 3 is the illusion of safety, the comfort of seeing your principal intact while your purchasing power slowly slips away. So think about tools like high quality bonds, CDs, maybe certain annuities. They can keep your account value steady on paper, but when inflation is running close to or above your return yield, the real value of those dollars shrinks. And it rarely feels dramatic in the moment, which is why this is so dangerous. It's a slow erosion that shows up 5 to 10 years later as a thinner lifestyle. So you'll see it as fewer vacation trips, tighter healthcare budgets, and less margin for life's surprises. In other words, it looks like you have safe principal, yet the value is shrinking over time. So the key is not necessarily to abandon these instruments, but to understand their role and pair them with strategies that have a credible path to outpace inflation without demanding your constant attention. Okay, so what does this mean for investors? Well, buying power is what funds your life, not your account balances. In other words, if your nominal yield is 4%, but inflation runs at 3%, then your real return is roughly only 1%, and that is often negative after taxes. So over a decade, that gap compounds, and the result is something you're left with a portfolio that worked, numerically, but didn't keep up with the cost of living, especially in categories like housing, healthcare, even travel. So, I want to go through a quick example of this inflation risk that you need to consider. Imagine $100 earning a stated 10% return for a year. On paper, that grows to $110 after 12 months. But if inflation is running at 3%, that same investment that cost $100 last year now costs $103 when factoring in inflation. So your purchasing power isn't the full 10% that you were hoping to earn. It's roughly the difference after inflation is applied. So the formula is stated return less inflation rate equals your real return. The back of the napkin math is about 7%, but the precise math is actually a little less. It's more like 6.8%. So you can actually use this example to, expand it over time with the same math each year over 5 years, over 10 years. And then you can quickly see how much purchasing power you're losing at what feels like a compounding rate. So here's how to beat that trap. First of all, you need to understand what your own personal inflation rate is. Look at the categories that you actually spend your dollars on. You can do this by looking at last year's expenses versus what those same costs were now this year, right? So if you happen to do this exercise, and let's just say, for an example, last year's cost versus this year's cost, you have a 5% increase. That 5% is your personal inflation rate, okay? Because it's directly tied to what you spend your dollars on. Step 2, always calculate your real yield, right? So take that stated return less your personal inflation rate. That will give you your real yield, okay? As an example, a 3% CD, when inflation is 4%, equals negative income. It's -1, and that's even before taxes. Step 3, balance safety with inflation protection. Some investors pair fixed income products with real assets or alternative strategies to keep their income ahead of rising costs. So after having gone through all 3 hidden risks, let's redefine passive income with some precision. True passive income arrives on a schedule. It does not require your ongoing effort and holds up when life gets busy. It should be understandable, like you know where that yield comes from, and it should be secured by something tangible or by reliable contracts. The test is simple. Ask yourself, is the system set up so that the money keeps working when you're not? Now, when I say true passive income, here's what I mean. These are the 5 qualities that you need to look for. First, predictability. Distributions occur on a set cadence. Second, simplicity. There's no operational job for you to do. Third, having inflation awareness. So you have a strategy that has a credible way to preserve purchasing power. Fourth, collateral or contractual strength. So your claim on repayment of your investment is backed by assets or enforceable agreements. And then finally, clarity. Make sure that the risks and mechanics are transparent so that you can then make informed decisions. Before allocating to any passive strategy, make sure that you're going through this list and ask yourself this too. Is the income predictable and reliable based on the underlying mechanics? How much of my time or attention will this realistically require? After inflation and in taxes, does this real yield meet my needs? And then what stands behind these payments? Tangible assets? Is it tied to priority of claim? Personal guarantees? How about all 3? And then do I clearly understand the risks, the scenarios where things can go wrong? And then how are those mitigated? If you can check all these boxes, you are far more likely to have peace of mind income that supports your retirement lifestyle. Here's a practical framework to review. Separate growth and income so that each has its own job. Ensure that your income sleeve is genuinely hands-off by design, not by hope. Calculate your real yield after inflation and taxes to keep expectations honest, and then anchor part of the portfolio to real assets or secured claims so that your cash flow isn't solely dependent on market optimism. And then I think it's really important to revisit this plan at the bare minimum annually, but I would prefer quarterly for you so you can still verify if this still fits your life. So let's talk about what fits all of these qualities. Well, real estate secured lending is one way to pursue the 5 qualities that we discussed. Instead of owning properties and tenants, you finance vetted borrowers against real collateral and defined terms. No more rental income. Instead, you're collecting interest income based on contracts. So your role then focuses on underwriting and protecting capital. Of course, like any strategy, it carries risk, but the mechanics are transparent. Interest accrues by contract, payments are scheduled, and claims are secured and enforceable when structured properly. Now, if you don't want to learn underwriting, if you don't want to manage that process yourself, I totally understand that. You can delegate it to a professional fund manager that you like and trust by investing in them. So then it's the fund manager's job to underwrite, to monitor, to protect capital with a defined mandate, not your job. Instead, your job is to evaluate the manager. So when looking for that, look for a documented track record, look for conservative loan standards, clear reporting, a third-party verification, especially when it comes to property values, and then make sure that you have a strong alignment on fee and incentives. And if you are an accredited investor and you're considering any private deal, any private fund, only review and make decisions through official offering documents like a PPM. That helps you to understand all the risks and liquidity terms. Don't just hand over 5 or 6 figures to John in the audit department because you think he's an Excel wizard. Ensure that you are protected both functionally and legally. I think that you'll also notice too, when you separate income from growth, when you avoid operational traps, when you respect inflation math, you build a portfolio that supports your life rather than a portfolio that hijacks it. The goal isn't maximum returns at any cost. No, it's right-sized returns with right-sized risk so that you can focus on family. You can focus on work you actually enjoy. And you can focus on the parts of your life that money is supposed to enable. Okay, here's the most exciting part of the webinar. So before Q&A, I'd like to announce that we're going to be sending everyone in attendance today our free ebook, which is Passive Income Unlocked. You guys are going to love this. This ebook breaks down what real passive income looks like in practice and who it works for. You'll see why many investors invest in real estate debt and how that differs from equity investments. It also highlights the numbers that matter so that you can then evaluate opportunities with confidence. And then finally, there's a red flag section so you know what to avoid, and we give you a few simple first steps. So what we'll do is we'll send this ebook out via email to everyone. So I hope everyone enjoys that little freebie.